Hello and welcome to this week's edition of our Level of Interest Market Briefing. My name is Oliver Sperring, I'm head of trading at TradeNeon, and I welcome you here on our YouTube channel. Yesterday was Easter Monday. The markets were nevertheless open. Trading was correspondingly quiet, however, as naturally, few institutional players were in the market. Let's still take a brief look at the day because I'd like to show you how our levels do their job even on such quiet days and give us a lot of information about the market context. At the open of the US cash session, we found ourselves here at the lower edge of this Vanna bear zone, which also held directly. The market then rose to this level here, a combination of volume profile level, order book liquidity, and bearish acting hedging level. It tested the high from the pre-session once more, but couldn't sustainably take it out. In the rest of the session, the price then moved in a range between these levels and also repeatedly reacted to this bullish hedging level here at 6,632. On such range days, we are well advised to think in both directions and at the extremes of the range, provided these are supported by our levels, to look for mean reversion entries. But let's get to today and the outlook for the week. After Trump's spectacular speech yesterday with a maximally interesting closing statement, the rest of the week is also packed with important news. Today starts off relatively calmly, with the durable goods orders at 8:30 a.m. Tomorrow evening, however, is the FOMC meeting. On Thursday, it continues right away with PCE price index data, GDP, and initial job claims. And on Friday, we then also have CPI data. Apart from the unsettled fundamental situation, this news could therefore be a decisive directional indicator for the equity markets in the coming days. Looking at the 4-hour chart, we see that we are currently still in a clearly downward directed trend and have not yet made any higher highs, despite the optimistic seeming previous week. We should therefore still be cautious and not too optimistically into bullish swing trades. The orange dashed line represents the expected move of the week that the options markets imply, a maximum of 130 points of movement in either direction this week. An upper target would therefore be around 6,750 points. To the downside, the market should find support this week at 6,500 points, which corresponds to about 50% of the current upward movement. Today itself appears to be choppy. The actual expected move of 58 points is in a very moderate to small range relative to the previous week and is narrower than the expected move calculated with Black Scholes. To the upside, we therefore have a clear cap with a combined level of span interval and expected move that the market can only very difficultly clear today. In the pre-session, the previous day's high was already tested, however, it could not be sustainably taken out. What immediately stands out is that between the previous day's high at 6,660 points and the hedging level at 6,620 points, we have a zone with a relatively large number of levels in a confined space. We see here the previous day's VWAP closing price as a reference level, the settlement price, a dark pool level, and various dealer hedging levels. Internally in our training, we refer to such price areas as no trade zones. We have a lot of institutional trading interest in a confined space and can expect rangy sideways movements in such zones, since the market here implies a fair value that allows much two-sided trading. It is therefore advisable to look for entries rather outside this zone. Should the market manage to break the current daily high to the upside and penetrate into this bull zone between 6,670 and 6,700 points, then I would tend to look for long entries here. If, on the other hand, we sustainably break the expected move at 6,600 points to the downside, then we should be cautious here. Since large trend movements are rather unlikely today, I would rather wait a bit and see how the auction develops over the course of the US cash session. Should we, as expected, get a classic D-shaped volume profile, then on such days it is advisable to look for long entries in the lower level zones and for short entries in the upper zones, classic mean reversion trades. The 6,600 would lend itself to this, but also the span interval at 6,580 points. Only when the market would clearly stabilize below this span interval would I be clearly short-oriented and would adjust my strategies accordingly. I think the market is currently behaving rather in a wait-and-see manner with respect to the upcoming news events and will probably only really pick up speed in one direction or the other after tomorrow. Then day trading will also become a bit easier again. Let's take another look at Volant and examine the dealer hedging data. In the 0DTE gamma chart, it stands out right away that we have a classic GEX picture. At lower prices, lots of negative gamma, at higher prices, positive. Customers have apparently bought puts and sold calls. As you know, in the negative area, we have to expect increased volatility as the negative gamma levels tend to accelerate price movements in both directions. As far as Vanna is concerned, this area tends to seem rather bearish as long as the spot-vol relationship is intact. The positive Vanna below the price will attract the price. In this case, the negative Vanna above the price will repel it. Only when the market has run through the zone and reaches its lower edge does a kind of rubber band effect arise that could catapult the market back in the opposite direction. At a higher level, we continue to see rising aggregate Vanna, which should have a bullish effect on the market in the medium term, provided implied volatility continues to fall. That naturally gives hope. The daily data hedging in the statistics channel, currently at negative $6 billion, is at a relatively low and neutral value with a tendentially bullish effect. But we will, of course, be wiser here once the market has opened later at 9:30 a.m. Until then, I wish you all a nice and successful trading week. Stay healthy, and if you'd like, we'll hear from each other again next Monday for the next edition. If you're interested in Volant, you can find our affiliate link in the description of this video. With this, you get a 10% discount on your subscription for the first 6 months. Level of interest, you can, as always, test free for 7 days. You can find all further information about it on our homepage, TradeNeon.com. Here, in addition to info about the software, you'll of course also find free tutorial videos on the individual levels and level types. See you next time.